How frequently is that? Is it on a daily basis you do look at your mark to market, or is it only Saturdays you look at what's happening in your portfolio?
My brother who worked at Goldman Sachs, he gave me some very, just these simple things. Anytime a stock doubled, he sold half of it.
How frequently do you look into your portfolio? Number one. And number two, have you seen this over the past few years that you've been looking into it lesser and that's better?
How do they start this journey of doing investing come trading? I would still say that you are a trader, but I don't know why you are not accepting it that you are a trader. Hello everyone, welcome to Face2Face Global, and this time we are going to have lots of inspiration because we have a lady who is a US investing champion or almost a champion, and she's from India, a person native Indian who went to US, got settled there and doing wonderful work and making all of us extremely proud with her trading skill. Although she would believe that she is an investor, but I think her style is very unique. An investor and also a little bit of trader who can time the market very well. This face-to-face, I had Abhijit Paul also joining me, and both of us tried to get the best out of Vibha Jha. So you're going to have a lot of learning. It's a 1 hour session and you're going to watch till the end, because till the end, if you stay, the real pearl remains till the end. So hopefully you are going to enjoy it. I enjoyed it thoroughly. Let India get inspired from our lady settled in US. All right, welcome Vibha Jha and welcome Abhijit again.
Thank you. I'm very happy to be here.
Happy, very, very excited. In fact, I've been waiting for this for some time now, that I have to interact with a lady who's going to do wonderful work in inspiring generations of traders. I mean, I've not been able to come across many ladies who have done wonderful as a trader, or even if they have done wonderful, I don't know why, but they are resistant to share their journey with us. So that's why I was very excited to have you, Vibha Jha.
Thank you.
Now, let me start by introducing you to my audience that US Investing Championship, that's a big deal, yeah? And if someone is there in that list, that means someone has arrived. So Vibha Jha is part of that list, and she obviously has some connection with India. She's in US and she has done wonderful as a trader there. And her story is very, very interesting. So we are very keen to know about your story, Vibha Jha, first. How did you land up there? What made you reach there? And from there, you have become a trader. That itself is so exciting. So please tell us everything about your journey.
Yeah, sure. So let me start from the very beginning. I was born in Devghar in Bihar at the time. Now it is Jharkhand. So I came to the US when I was 3 years old. My father, he is an engineer. He graduated from IIT. But when he came to US, nobody knew IIT. So here's this person who went to one of the best university in India, and he went to US and he had to start from scratch. And then my mom, they got married very young. So she, didn't speak that much English. Her father, my grandfather, was a professor of Sanskrit in Devghar. So she had a college education, even though she was very young when she got married. But when she came to US, she came with 2 little kids. I was 3. My brother was 2. She hardly spoke English. My father was working all day as a drafting assistant because he couldn't get a job as an engineer. And then in the evenings, he was going to get his master's at a university from the US so that then he could start working as an engineer. So my early childhood, my brother and I, we spent a lot of time with our mom. Our dad was hardly around, but I have many happy memories. On weekends, when my dad was home, my parents would play like Kishore Kumar, Lata Mangeshkar. So I grew up listening to that Hindi music and, grew up eating chawal dal sabji, like that was the food that my mom cooked. And so, it was an interesting journey for me because I had this very strong, family connection because of my parents to India. But at that time, in the 70s, early 70s, there was not the kind of interconnectivity there is today. My grandparents, they didn't even have telephone. My parents used to send telegrams, like it was just a very letters, letters would arrive months after something happened. So, growing up, I didn't have any exposure to business or investing. The most important values in my family growing up were family and education, because, both on my father's side and my mother's side, the grandparents, everybody was very educated. And so we basically grew up with, education is the biggest priority. And so, when I was in high school and college, I had no interest in business. I wanted to be a lawyer. And then when I graduated from college, I thought, okay, well, I need to take like a year off to earn some money to go to law school. And I ended up getting a job with Aetna, which now it doesn't exist on its own anymore, but it was one of the largest insurance companies. And I lived in the insurance capital of the United States. So there were a lot of insurance jobs and I loved it. And I'd always been good in math, but like I said, my interest was more law, but I just loved the business side. It was so interesting and challenging. And so I really spent sort of the next several years growing my career, raising my family. And then it wasn't until it was probably, well, again, this is all happening like in the mid 90s, but my brother at the time, he's still my brother. He wasn't just my brother at the time, but he was working for Goldman Sachs as a computer engineer. And so my first exposure to any kind of stock investing came through him because he was, hearing about all of these technology companies and he would tell me, Didi, you should invest in stocks. Like, why are you putting your money in like savings bonds? And I said, I'm not investing in stocks. That's too scary, And one story when I was buying a car and, here, like before you take a loan, you have to put a down payment on a car and then you take loan. And, my father, he always told us, don't go into debt, try to not use cash or do whatever, like don't go take on too many loans. So I always, whenever I bought like a big purchase, I tried to put as much cash as possible. And this is again, 1995, my brother's saying, buy Microsoft. Why are you putting so much money in the car? I said, I'm not. And then 4 or 5 years later, I was on maternity leave. This is 1999. And I was watching financial news on TV and I was watching the Microsoft stock ticker come on the TV. And I was looking at how much that stock was. And I said, oh my goodness, I could have bought 5 cars if I just bought a few shares of Microsoft. And so that's when I got excited about, oh, this isn't hard. Everyone is doing it. I can do it. And then I bought Microsoft and I lost 80% of my money in a year. So luckily at that time, I was very young. I didn't have that much money to lose, but I lost pretty much all of it. And so that was my big, really the beginning, I would say, of my true journey was realizing there is so much opportunity in the market. There is so much reward, but there's also so much risk. And you can't just, pick as good as a company is, you can't just pick a company and say, oh, I'm going to buy this and I'm going to make money. You need to know what you're doing. You need to learn. And then I really began that commitment, which was a big part of my journey. My commitment was to learning and learning while I was, growing in my career. At that point, I was vice president of a pretty big division within Aetna, growing young kids, raising my family, just trying to do all of those things while still trying to learn how to invest. So, that is one, lesson. Again, I'm sorry I'm talking so much. Please interrupt me. But one important lesson is even for anybody who's doing this journey, you have to do it in a way that works with your lifestyle, because everyone has commitments. So you have to figure out how can you do this within all of the other things that you have going on. But I'm proof positive. Anyone can do this.
Superb. We don't want to interrupt in the middle for sure because we just want to give you the best ear. Is it possible? If I can ask you a question, and obviously I have been joined by Vibha Jha and his mind also works quite differently. So you call yourself a trader or investor, or you call yourself an investor first who turned into a trader? Who are you?
Yeah, I'm really an investor. And I know a lot of times I've been characterized as a trader because of some of the competitions I have entered, and I have incorporated some more trading elements into my style. But I start with fundamentals, and my intention when I purchase a stock is it needs to be a business I believe in, and it needs to be at a time in their cycle where they still have a lot of runway to grow. However, one of the books that really, really inspired me was William O'Neill's book called How to Make Money in Stocks. And he talked a lot about the technical aspects. And I had never been exposed to the technical aspects. The fundamentals, even as a business leader, I understood the importance of earnings, the importance of sales, the importance of, being able to have a good return on equity, a strong leadership team. I understood all of those components. I had no idea what a chart was. I had no idea what a cup with handle or double bottom or any kind of consolidation is. I had no idea about even market timing. And so what I realized is even if you have a long-term investing perspective, you need to understand some of the technical aspects of trading if you want to retain your money and if you want to manage your risk more effectively. So I still would characterize myself as an investor, but even for an investor, you have to understand the technical aspects of the market if you want to really maximize your results.
That's great. If you may, I definitely would like to ask a question extending the fact that you started off with the company's fundamentals, right? And then you figure out that technicals may help you or will help you to time in and out of the market. So essentially,
Yes.
it's a timing tool. But today, 2025, after so many years of, taking decisions, how will you weigh, like how much of your decision is fundamentals percentage wise? Is it 50-50, 60-40? Or is it a stage where you will not take a call without the charts? Means how much importance, weightage would you like to give to both the verticals?
Mhm. So that's a very good question, and one that I have been asked many times. And it is hard for me to put a percentage because I always start with the fundamentals. That being said, I will not buy a stock without looking at the chart, and I will not buy a stock without understanding where the overall market is. So that was one big lesson that I also learned from Bill O'Neill and the style of trading that he or investing that he advocated was that 3 out of 4 growth stocks. So again, when I do buy stocks, I'm a growth stock investor. I don't buy value. I of course I care about the valuation, but I buy based on companies that have growing earnings and sales. So those are the types of companies I look for. For those types of companies, he said 3 out of 4 will follow the direction of the general market. And I want the odds in my favor. That doesn't mean that there's 25% that won't work, but if I'm putting my hard-earned money into an individual stock, I want to have the odds in my favor, right? So today or the past 2 weeks have been a perfect example. Actually, the past few months, the U.S. market has been in a downturn from the December, mid-December is when a lot of the growth type of companies I look for had peaked. The last 2 weeks, the market has gotten even worse. It is, in, what is considered a correction in terms of where the overall broader indices are more than 10% off of their recent peaks. So right now for me, I am sitting back. I'm not in all cash because I am a long-term investor, but before this correction started, even at the end of December, I was looking at my portfolio. I was looking at my individual holdings. I was looking at what percentage each holding was of my total portfolio. And I scaled back my risk because that's something I do every year. And so whatever I am in now is something I'm in with the intention that there's going to be ups and downs, and I'm prepared to hold it. But I am not even touching anything new until I see that the market direction has shifted.
All right.
Okay. May I? Sorry, we'll have to keep on doing this because I'm sure
Yeah, of course, no problem.
both of
I
us,
like this feels more, like that's been one of the things with COVID, and also because I quit my job, I don't have as many interactions with, professionals and business professionals. And so having these kind of discussions, it like really like lights me up. It makes me happy.
Superb. Thank you. So, because you mentioned that you invest in growth stocks, those are typically high beta. So, in bull run, they obviously will go up very fiercely, and in bear market also they will get punished the most.
Hmm.
And this is the market we are in right now. We are in a punishment zone. How do you manage your risk? Is it because you said that you're still invested? So my presumption is that you may probably use position sizing to manage your risk when you see market not behaving the way you
Hmm.
want. So that's my question number one. And just part B of this question, have you objectified in some way the market view? Because what happens that when market falls, we realize that, oh, market has fallen. But how do we know that market is not in a great shape for us to keep large position in these growth stocks?
Hmm. So let me answer your second question first, which is about have I objectified? So I personally have not strongly objectified it, but some of the tools which I use, so I use Investors Business Daily, which I believe they also have a presence in India, although I'm not familiar with exactly what tools they offer there. But one of the tools that they share on a daily basis is what they call like their big picture or their market pulse. And in the market pulse, one of the things they track is distribution. So when the market is under heavy selling, they have different definitions which they use. And when you start to see a number of days of heavy selling that are happening in a relatively short period of time, that starts to tell me that the market is weakening. So, in Bill O'Neill's traditional methodology, he said, okay, once the market has 4 to 5 days of distribution, which is heavy selling, meaning it's on high volume and it's, pretty large percentage in terms of how down the market is, that's a sign that the market may roll over and you have to start getting defensive. So I do look at that. But also one thing that I have learned is sometimes when you wait for the market to weaken, you may have waited a little bit too long. So that's why every year when I look at my portfolio, I look at it at the end of December, partly because it coincides with our tax season here, but also because a lot of times that's when there have been a lot of strong gains in technology stocks. That tends to be a good time to look at your portfolio and figure out how to scale it back, because we go through a lot of choppy times, at this time of year. So and that this connects to your first question too. So I do use position size to manage my risk. When I first enter a stock, I wait until the market has emerged from a correction and is turning around. So, for example, if I wanted to initiate a position in something now, I would be waiting until the market showed a clear bottom from where it is right now. And that doesn't happen in one day. It takes several days to see that the market is improving. So if you enter at the right time, a lot of times it protects you from losses because you're getting in when the wind is, at your back, when the market is in your favor. And for any initial position size which I take, I don't want to risk more than 1% of my capital.
Okay.
Okay. So that 1% of my capital, that's what I use to back into my position size. So for example, if I were to take a 10% position size and I wanted to just risk 1% of my capital, then I have to set a stop loss of, if the stock price falls 10% below my entry point, I need to get out. Otherwise, I'm risking more than 1% of my capital. One of the things that I found, which is where the technical aspect of trading comes in, is it's very common for growth stocks, as you said, they are in bull markets. They may go up 1.5 to 2.5 times as much, maybe not even more than the market. When the market is bad, they correct 1.5 to 2.5 times, if not more. So, you have to be prepared for that. But these growth stocks, even in a completely normal, pullback or correction, they may come down 15% or 20%. So how do you, at the beginning, when I first started trading, I tried to consistently follow Bill O'Neill's rule, which was when it drops 7 to 8% below your purchase price, you just get out. But what I realized is for these high beta stocks, they can go 7 or 8% in one day, the range. So then I said, no, I'm not going to just look at the percentage. I'm going to look at, when I look at the chart, what are areas of support? What are, key moving averages or something that I follow in the US charts that I look at of where the institutions tend to come in to support them. If it is a liquid stock and if it is a stock that is, has good growth potentials. So I learned to back into my position size. So if I wanted to buy a stock and maybe it was, even say it's 10 or 11% above a reasonable average, everybody knows that. So, you have to allow that it might come 2 or 3% down. And also I sometimes like to wait, most of the time, I like to wait for the end of the week to see, does the price smooth itself out? So to allow for those big fluctuations, many times my entry size position is maybe 7%. It's not 10%. It might be 5%. It might be 7%. And then if I'm buying a company at the right time that has very high earnings and high sales and is at a relatively early stage in their growth career, those stocks can go up 4, 5, 6, 10 times. NVIDIA is one example. I originally bought NVIDIA in 2016. I still have a position in NVIDIA now. Now, a lot of it I sold on the way up. My brother, who worked at Goldman Sachs, he gave me some very, just these simple things he used to do that I incorporated them, especially because I was so busy. So one of his, again, simple rules was, and remember, he learned investing in the 90s when this was happening all the time. Anytime a stock doubled, he sold half of it. And that way he locked in his gain and then he would let it grow. He had money to put into something else or put in cash or do whatever. So again, this is very simple rule from the 90s, not looking at any chart, not anything. So I, would incorporate that into my thing too. So with the NVIDIA, that yes, when it doubled, I sold it. When it doubled again, I sold more. And so when you start early enough, then you can allow them to come down. So yes, right now NVIDIA is not doing well, but that's okay.
True. I guess I can ask a question here that sometime back you were mentioning that you definitely take a look at your portfolio end of the year, December. I can make a guess that you don't look into your portfolio that frequently. So how frequently do you look into your portfolio, number one? And number two, have you seen this over the past few years that you've been looking into it lesser and that's better? Means, have you seen a change in yourself throughout the years?
Yeah, so I should clarify. So I do look at my portfolio very regularly, but I use the end of the year to balance it from the perspective of, okay, let's say there's something I invested in and I wanted it to be at the most 10% of my portfolio. And by the end of the year, it has grown into a 25 or 30 or 40% position. I want to scale that back. So when I'm saying I analyze my portfolio at the end of the year, it's more from that overall portfolio management and risk management perspective on a regular basis, because I've retired from my job since 2013. So all of the, my husband, he's I would say semi-retired because he's retired, but then if a project comes up that he's interested in, then he works and then he's retired again. And so, we have to have enough money set aside from our investments that we can manage our life and our expenses, without stressing out. So from that perspective, I do have to look at my portfolio very regularly, but when it comes to making decisions on whether to buy or sell a stock, I generally will make those decisions looking at the quarterly results, looking at, do I still believe in this company? Is there something else I would rather buy? And then I will use that to decide, whether to get in and out of something, like from initiating. But for any positions I hold, I monitor them on a quarterly basis. And then again, I will sell them if I don't believe in the story. If the market is showing that it is deteriorating and the stock is already a bigger percentage of my portfolio than I would like, then I will make those decisions. But I try to make decisions from a longer term perspective rather than the shorter term. But I do need to see what's happening with my portfolio because we have to live off the money.
True,
So
especially when you're
how
retired.
frequently? How frequently is that? Is it on a daily basis you do look at your mark to market, or is it only Saturdays you look at what's happening in your portfolio?
So it depends, and the question that you had asked earlier about has it evolved over time? The answer to that is yes, that it has evolved over time. But so I do look at the market on a daily basis, but generally just for a few minutes to understand what's happening. And is there some change in character in the market? Is there some change in direction? So the past few weeks, I have been not just spending a few minutes, I've been spending hours because I'm really trying to understand what it seems like. Okay, we keep going lower and lower and lower. Like at some point that will hopefully bottom out, but I'm trying to really understand what is going on. So in that scenario, I'm spending, like at least an hour, if not more. When it comes to monitoring the individual investments I have, I typically will look at those on a weekly basis. I don't care as much about the day-to-day fluctuation. I look at them on a weekly basis. And on a weekly basis, I do look at, particularly when the market is weakening, I do look at, of everything I'm holding, what has held up the best, meaning which stocks have gone down the least, which have gone down the most. Is there some adjustment I need to make based on what is happening in the overall market? So I do that on a weekly basis. When it comes to screening for new ideas, I used to do that much more actively in the past. When I was in the trading competition, the first 2 years in 2020 and 2021, 2020, I had a 155% return. And in 2021, I had a 100% return. And that was coming in number two to Mark Minervini, who many of your traders may know. He came in number one. I came in number two. Definitely a distant number two behind him, but still it was something to be proud of. In those years, I was very actively screening, making much more shorter term trading decisions. It was a little bit easier because we were still in COVID. There was nowhere to go. My family was home with me, there was nothing else to do. But then after everything opened up, and it also gave me that realization of, you can make all this money, but what is it for? Like, you want to enjoy your life too. So in 2023 and 2024, 2023, I came in number two again, this time with a roughly 70% return. In 2024, I came in number 9 with a 78% return. This is in like the $1 million plus divisions. But those years, I started to move more towards ETFs, which Abhijit will probably appreciate. For me, what has become my niche, which I don't necessarily recommend to everybody, you need to have a skill set and experience to do this. I use the triple leveraged ETFs. Oh. And so, but to me, in some ways, they have less risk than a single stock, because a single stock can fall 40% in a day, 50% in a day, maybe more of these high beta stocks. The ETFs, yes, they may have a really bad day, but even a really bad day, like for example, with TQQQ, which is the triple leveraged ETF that I like, it's still generally not more than 8% or 10%, which is a lot, but compared to a 40% drop in a stock on earnings, it's not as much. So with the ETF, I only have to spend a few minutes a day, and mainly I'm looking for character change. As long as it's doing what it's supposed to do, I let it keep going. When it starts showing a lot of weakness, then I start getting out. And then once I get out, then I wait to see a clear bottom. So then I'm just sitting and watching. So it requires a lot less time. And because I only actively trade one ETF, I know the chart in my head. I know the highs. I know the lows. I know the dates. So all I need to do is look at the ticker on my watch, no matter where I am, and I know, okay, the stock is trading in, this ticker is trading in an acceptable range, or it's trading above the key moving averages. I know those numbers in my head too. I'm sorry about that. So makes it a lot easier to be more efficient with my time when I'm just looking at, for example, an ETF. And that's what has helped me cut back the time I spend in looking at the market. But for active and individual stock investing, you have to know what's going on, at least on a weekly basis, if not every day.
So true.
Superb. I mean, we are craving for this ETF rule in India. Unfortunately, Indian regulator doesn't allow these kind of ETFs. But yeah, the ultra leverage ETF in US is just a amazing product. And I interacted with a couple of people who use the same in bond as well in US yield, and they made quite a lot of money when the bond yield went down from 4.9 to 4.2 recently. Uh,
Mm-hmm.
Ma'am, it's actually a very structured way of looking at from stock, you have moved to ETF, and you're only focusing on one ETF, which gives you such a big advantage of, mental, what do you call that, mental muscle build up in
Yes.
that particular instrument. Maybe someday we will also get the same in India. But you just mentioned that you also observe the weakness in ETF. I'm still
Mhm.
curious to understand what's your trading template like? Does it like you use the word moving average, and how do you find that it is getting weak?
Hmm. How do I find it's getting weak? So one other interesting thing I'll share. So many people have asked me how to systematize what I do because when it comes to the ETF, since I have looked at it for so long, I just have to look at the chart and look at what's happening right now. And I can say, okay, like this feels like what was happening 6 months ago, or this feels like what was happening 1 year ago. So I'm not trying. One of my another brother, who's also a computer engineer, he's trying to help me take some of my instinctive things of where I look at, like I do have some clear buy signals and sell signals, but where the systematization has to happen is when I see sell signals, I have 7 or 8 that I look at, but sometimes just 2 will happen, like what happened on December 16th. And I said, I'm getting out. Other times, 4 or 5 may be happening, and I'm still just watching it. So we're trying to figure out if there's certain, patterns where it makes it more so that it can be objectified to, as you said, to help people understand that weakness. But right now, the most basic way that I look for the weakness is if there is, and because I'm using an ETF that's based on the broader market index, it's or the technology, the top 100 technology companies, or QQQ, which is in the NASDAQ. So they're not all technology, but they're mostly technology companies. That I'm watching how that is doing, and if that is showing that the market is weakening, then I'm saying, okay, I'm expecting that the ETF is going to weaken too, and then I start taking that into consideration.
So you start selling in a bit, like you don't sell in the whole go, right? You start spreading up
Exactly.
some trades. Okay.
I start selling in increments generally as it's still on the way up.
Okay.
But, some other ways where you can tell the market is weakening is, let's say, and we can use maybe from September to December in the US as an example. And oh, by the way, I know that right now is a tough time in India too, but India, I think, was the only country that had 8 years. I was researching some of the results, had 8 years in a row as of the end of 2024, where the major indexes in India did well every year. So that is a huge accomplishment of which I was proud as an Indian. But to use like the U.S. from September to December, like, the market had come down, especially again, the broader indexes, the technology indexes had come down very hard in August, September. But then from September to December, they went up significantly, So when that's happening and there's a lot of, like very fast growth in share prices that have happened, then I also start to sell a little bit at that time because I want to lock some of those gains in. And that takes some of the pressure off when the market is weakening.
And what do you do with those gains?
I keep them in cash.
And
So
wait for the right time?
I keep them in cash, waiting for the right time. And also because we live off our money every year, like I always try to maintain a cash position in our, not in my trading account, but in the account that we use to, live all of our expenses, cover our expenses. I try to maintain like up to 2 years worth of cash. I know that in the prior environment where there were high interest rates, and, even our bank would say to us, "What? This is crazy. Why do you keep this much cash?" But it's because I don't want to be worried about how am I going to pay my bills? How am I going to buy food? How am I going to, pay for our mortgage? I trade from a place of calmness, even when the market is bad, like it is right now. In US, the average corrections have generally not lasted more than 2 to 2.5 years. Some years it is more than that. But so I have that peace of mind that I have enough cash that even whatever we've gone through in the past 2-3 months, I don't have to worry about that unless it stays like this for another year and a half. Then I might be in a little bit of trouble. But that's why when I sell, I try to, yes, I keep it for a better time to go in, but I also take some and add it to my cash reserve so that in months like this, I'm not worried.
That's perfect. In fact, I think that it's more to do with the roots that you have, that
Yeah.
conventional approach of to save. I think that's more to do with your roots rather than an American probably will not understand, especially if he's a banker. Why are you
Mhm.
sitting on so much cash? And you won't be able to
Yeah.
make him understand that's because of my roots. I come from a completely different soil. But
Yeah.
yeah, I think that's the correct approach.
Thank you.
So, Vibhaji, one observation from my side is that because you were working and you come from a family also, your husband is also working, and I feel that you have money to take care of your lifestyles,
Hmm.
and whatever you are doing in trading is actually over and above on top of that, right? So
Hmm.
my question is, based on this background, which I've understood, how important is to have an alternate income or a stable earning to meet the necessities to become a
Hmm.
successful trader? I hope I'm able to clearly
Yes.
communicate because it really adds a lot of confidence inside you that I cannot go bust. My family will keep on running even if I
Mhm.
go wrong in trading.
Yes, it makes a huge difference. So, some of the traders that have reached out to me, they're very young and they're so ambitious and they're so driven, and it's so exciting to like see their passion and their interest. But a lot of times like they quit their jobs because they want to pursue this full time, and yet they don't have capital. And, sometimes if you're in that situation of you're, living with your parents or you're still in college or, you may be okay, but when you're trying to take care of a family and take care of your responsibilities to your parents or your kids or whoever, it's hard to do that. So, I started very young. So because of that saving mentality that you referred to, even though at the beginning I wasn't putting it in the stock market, I was always saving. Like even when my husband, he's also his background is an engineer from IIT Delhi, but he was always interested in business. But even at the beginning, when we first got married and we bought our first house, we bought a house that we could afford on one income because we said, okay, if something happens to one of our jobs, because, that's very common in the US, I'm sure now it's common everywhere, but, you could be the best, hardest worker in the world and your company gets acquired or, your job gets eliminated because of different conditions that have nothing to do with your performance. So we had seen that happen to my father because he worked for a utility company, very, conservative company. My mom didn't work. And then when he was 54, his whole division got eliminated. It was a planning division. And this is, again, the market was going through a very difficult economy, was going through a very difficult time in the early 90s or yeah, it was early mid 90s. So his job got eliminated, and then it was a scramble. And luckily, by then, my brother and I we were both working, and my parents didn't have any debt. But, I had two very young brother and sister, so I didn't want that kind of pressure. So because we made that decision that we will live off one income, the other income we saved it and we invested it, and so that gave us capital to be able to trade. And in US, there's a culture, especially in the big corporations, of you get bonuses. So in addition to your salary, based on the performance of the company, especially I worked for a big public company, publicly traded company, I would get generally a very good bonus every year because I was very hardworking, committed to my career. And so we would always take half of that and put that into our investing. Then we would take the other half and spend it and enjoy it. But you have to build capital. And while you are building capital, you do need to have some alternative source of income so that you are not stressed, because sometimes some of the people that have reached out to me that quit their jobs and they decided to do the options trading or different types of trading that I don't even know what it is, but they lost all their money or almost all their money. And then they came to me and they're like, okay, I want to give you my money to manage because I need to make it back as soon as possible because I lost everything. And first of all, I don't manage people's money. But the thing that struck me was that when they were losing money, instead of taking a step back and trying to understand what was not working with either their system or the market environment, they just doubled and tripled down and took even more leverage, and then they lost everything. So I think sometimes when you are worried about how you're going to eat or how you're going to take care of your family, you might take risk that in the hope that you will make back the money you lost, but most of the time it works the other way, So I would definitely encourage people that, yes, I think it's very, very possible. I retired in my early 40s. It's very possible to quit your job and then be able to use investing to fund your lifestyle, but you have to build that over time. It doesn't happen overnight.
So true.
So, Vibha Ji, you are going to inspire millions of traders and investors all over the world. But there is one segment in our society which is learned women. I don't want to sound as if I want to talk only about women with you, but generally I'm saying that Indian women is so talented, especially the educated ones who are at home and who probably are figuring out what to do with their education or career or intellect. I would suggest, I would take a piece of advice from you that how do they start this journey of doing investing come trading? I would still say that you are a trader, but I don't know why you are not accepting it that you are a trader, but whatever your style is, how do you, would you like to recommend people, how do they approach this style and start working on it?
Yeah. I'm so glad you asked me that because this is something that's very important to me. I've not talked that much about it, I think, publicly because I'm not trying to exclude any one group. But I am, I still have relatives mostly on my husband's side that are in India. I have so many talented sisters-in-law, nieces, daughters-in-law. And they are so passionate and so driven and so ambitious. And, even in my generation that was in India, and even my mom's generation, but some of these generations didn't always have the opportunities. And now there is that opportunity. And so I really encourage them just to start somewhere, in many ways. And again, this is not to exclude men or to put anybody down, but women can be better longer term traders or investors because many times they have more patience. I'm not trying to stereotype anybody, but I think they did some data to show that at least in the US that there's a different mindset sometimes. And again, everybody has a different mindset. It's not that men think one way and women think another way, but I would definitely encourage them just to start. And no matter how busy you are, I get it. I learned to trade while working 60 hours a week. Vice president, traveling all the time around the country, 2 young kids. I remember being in California and it was, maybe 7 o'clock at night there, maybe 10 o'clock here. And my kids would call me for help with their homework, and so it is a lot to balance, but just start somewhere, And then the other message I would give too is you also have to have, this is for anyone, not just women, for men also, but you have to have a passion for this. Like, you have to enjoy it, because if it's something that you enjoy, you will take the time to do it. I used to take vacation days from work to read investing books. I would be on a plane and people are watching, whatever movies, and I'm reading like my trading books because I enjoyed it. If you don't, it's still really important to invest in something for your future financial freedom. And so I would encourage anyone that's starting, definitely for young women who maybe feel more, not confident about doing this. Start with, you have Nifty 50, you have many different index funds. When I started, I took half of my money when I was learning how to trade. I took half of my money and I put it into our S&P 500, which is our broad-based, basket of companies. And then, at least while I was learning, I still had my money working for me. So I would definitely encourage all women to try to do that learn while you are learning. Take some money, whatever it is you have, and do that systematic investment. We call it dollar cost averaging here. I think you have a term, systematic, investment purchases that people can do. I don't know if that is something everyone can do, but just pick some amount of money and some frequency, whether it is once a month, whether it is every paycheck, whether it is every couple of months, and be disciplined about no matter what's happening, no matter what market is up or down, you're going to put that money in. And then one other point I should have mentioned is, even though, to go from not knowing anything about business to going into trading and investing is difficult. For me, even when I started, let's say even like 1999, I had already been working at Aetna for 10 years. I was already like a business leader. I knew about business. I knew about earnings and sales. So maybe the first thing is just even educate yourself about business. Find a book, or find, the education you guys provide, or that other people, may provide. There's so much information out there these days, but find something where you just learn about business, learn about the market, because at the end of the day, and again, this is where my investor side is versus my trader side. Any stock I buy, I view them as a company. I view them as a business. I view them as, okay, when I was running a business, what are, so one, I'm jumping all over the place a little bit here, but sometimes people will project ahead. Oh, well, this is what the stock price should be 3 to 5 years from now. Well, I can tell you, having run a $4 billion business, it's very hard to predict even what's going to happen 4 quarters out from now. We have to commit to that, or we commit to, and you can look at historical, but, something like COVID can happen, something like a war can happen, something like a trade war can happen. It's very hard to anticipate that 3 to 5 years in advance. So, just try to learn the business, try to learn the fundamentals, so that, again, even though you might not necessarily use all of those things in your trading, at least you'll understand the business environment, and that will help you transition more to investing, because you'll know what you're investing in. Does that make sense?
Absolutely.
And
this
definitely.
is perfect.
In fact, I really like the part where you were sharing with us that you need to really have the passion or the love towards it. Because, I can share that I've been training for almost 20 years now, and the last 10 years have been predominantly teaching, interacting with those who really want to trade. And I've seen, I would say, 99% of them put the money in front, that, okay, this can be done. If done, then I can make some money. And if I can make some money, I can quit my job. So the plan of action is like that, back of their mind, that's playing out.
Mm-hmm.
But when things starts to go a little here and there, they lose that. They figure out, I don't like this. I'm not supposed to see so many reds. This doesn't feel good. So it's actually, you just reminded me that when I was in Mumbai, first 10 years of my career, and the first few years, they were the local trains of Mumbai. Okay. And
I've seen them.
I would carry a book with me, and I would read the book. So it just flashed back of my mind. So loving, passion for what you do, I think is going to take you the distance, or else it's so easy to just quit.
It is. And this is also something, really important, is that you have to know why you're doing it. You know, for me, when I started, part of it was, yes, I really enjoyed it, but also my purpose was I want financial freedom. You know, I loved my job, but working 60 hours a week and raising young kids. And, you know, like I hardly slept at night. You know, my daughter, she would say, Mom, I go to bed and you're like, you know, working on the couch, and then I get up in the morning and you're working on the couch, and, you know, like I hardly slept. And so when you have financial freedom, then you're doing what you want by choice. You know, I loved my job, even if I had all the money in the world. The reason I left was because, you know, for me, I wanted to focus on like this trading thing, but at least then you're doing it by choice, you know, like you are doing it instead of feeling like you have to do stuff. So that financial freedom, and then taking care of my family. So if you have those bigger purpose, like just making money isn't a big enough purpose. Sometimes people think it is, but then to your point, when you see all the reds, you know, then you're like, oh my God, this isn't working. I don't want to do this. But if you have if you like it and you have a purpose, if my purpose is I want financial freedom, then, you know, when I lost 80% of my principal, I didn't just say, oh man, this is like, no one can do this. This is dumb. I'm going to go. I said, you know what? I need to learn. How do I learn? So that's where having that higher purpose, and the purpose has to be bigger than just you. In my case, it was my family. Then it gives you that commitment and that discipline that, you know, okay, I didn't do something right here. How do I do better the next time?
Wow. Wow. What a way to end this conversation. The purpose is bigger than you. Thank you so much, Vibha. I assure you that you're going to inspire a couple of 100,000 women of India to go to that path which you have given to them. And I would seriously recommend people who are there on Twitter to follow you and get inspired from you. Thank you so much, Vibha, for this interview.
Yeah, and
Thank
I
you.
would just one thing I would just quickly like to add. So I have a Twitter handle. I don't use it that much, but if anybody would like to reach out to me via LinkedIn, particularly anyone, but you know, I do try to make time. You know, I can't talk to everybody, but I do try to make time, and I am going to develop some educational materials working with Trader Lion, because you know, I've been a very private person, but I do want to help other people. And if anything in my journey can help or inspire someone else, then I would love to share that.
Fantastic.
Sure.
That would be
Perfect.
great. So we'll share your LinkedIn profile also below this video for people to follow you and learn from you. Thank you.
Thank you.
Perfect.
Thank you,
Thank you.
Vibha, and thank you,
Thank you. Take
Abhijita,
care.
for your
Thank you.
time.
Bye.
So yeah, before we break, I would love to ask rapid fire. You know, I'll just ask you a question with two options. You don't have any option. You have to answer, pick any one of them. Is that
Okay.
okay? And
Of
quick,
course.
whichever strikes you first. Dal chawal or pizza?
Dal chawal.
Kishore Kumar or Taylor Swift?
Kishore Kumar. And Taylor Swift. Oh wait, I have to pick both there. I have to pick both. Pick both.
Okay,
I love Taylor Swift.
Kishore Kumar or Coldplay?
Kishore Kumar.
Okay, I knew that would be easier. Third one, given a chance to trade only ETF or only stock portfolio, which one?
ETF.
I knew that. And the last one, given a chance, only charts, technicals, no fundamentals, or only fundamentals, no charts?
Fundamentals.
Wow, I was expecting you'll go for charts. All right. Thank you. Thanks a lot for this
Thank
answer.
you. Thank you. Lovely. Thanks a lot, Abhijita, for ending this in such a lovely tone. Thank you, Vibha, again, once again, and it was
That
very
picture of
much
yours?
with you. Stay blessed. Thank you so much.
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.